Everybody, as promised, this is one of our more painful slide decks. I will try to make it as painless as possible, okay? Here we're going to be talking about financial statement analysis, how we compare companies based on their financial statements, all right? Um, Sometimes it's made more difficult to compare companies if they're using different accounting methods. Okay. So, for example, if company one is using LIFO for inventory, that's last in, first out, versus the average costing method. If you weren't with ECPI for your beginning accounting, in last in, first out, because of inflation, the last items that you buy tend to cost more than those purchased previously when we're talking about inventory. So if we're recording last in, first out, it makes our inventory more expensive than when we're taking an average of all of the inventory that we've purchased over the course of the year. Okay. It's important for managers to look beyond the ratios. We're going to give you some tools here, but always try to dig a little bit deeper. Um, be aware, I've said it a dozen times in this class, of your industry standards. Um, Make sure you're making an apples to apples comparison. Also, look at changes in technology. Okay. What other changes are occurring within the company? Overall consumer behavior and other economic factors. Okay. Um, so the first step for this is you want to make sure that your financial statements are in a comparative format. Okay. Um, so a single line item on your financial statements doesn't mean a whole lot. Okay. Um, it's important to draw comparisons between numbers on your financial statements. Now we can look at either dollar and percent changes. We can look at common size statements, or we can look at our ratios. We just finished on our last slide deck talking about some different ratios that we can use. Okay. Uh, mm, all right. So, horizontal analysis, this is commonly used by auditors. We compare, it's also called a trend analysis. We're comparing two different years within the same company. Okay, this quantifies dollar changes over time. And this can help you drill down on which of those changes are the most important economically. Okay. Also, if you describe the year-over-year changes in a percentage, that allows you to identify changes that are particularly unusual. All right. Better than raw numbers. All right. So we're going to look at Clover Corporation's comparative balance sheets and comparative income statements for this year and last year. Okay. So, here's our balance sheet. Remember that in order to look at overall dollar change, we want the current year minus the base year. In this particular case, the base year is going to be last year. Okay, you can compare more than 2 years. Just be aware of them. Okay, and then if you want to calculate your change as a percentage, that's the dollar change from this slide, okay, divided by your base year times 100, okay? So here are two examples of that. So just the raw cash value, you're just taking this year, subtracting last year to get this. Then you take this number, divide it by last year times 100% to get the percent change. Okay, so if you were an auditor and you were going down this list, okay, you would probably pull anything that's more than a 20% change, okay? So, we had 48, almost 49% less cash this year than last year, okay? But we had 50% more accounts receivable. Okay, these two make sense from an audit perspective. Okay, so we have less cash now, but we took a lot more receivables. So we're doing more sales on credit. Okay, that kind of makes sense. Inventory, 20% less. Okay, that makes sense. Prepaid expenses, 150% more this year. What the heck? We would flag that right away. That's a huge change. Okay, what the heck is going on there? All right. So you can see how when we have the percentages, it's more meaningful than just looking at raw numbers. Also, if you're trying to compare companies of vastly different sizes, um, to see which is performing better, percentage is a better way to sort of normalize those numbers, okay? And allow you to compare vastly different numbers, okay? You can do this for liabilities and stockholders' equity as well, just like we did this for assets, okay? Um, so, whoops, did I go too far? Yep. Let's look at the income statement next. Sorry. Okay. So again, our sales were 8% more. Cost of goods sold, 14% more. Okay. Gross margin was 3% less. Operating expenses were more than 2% more than they were last year. Our net operating income was 20% less. Okay. And that seems to be mostly driven by the largest contributor here is this cost of goods sold. Okay. So what happened here? This is when we get to drill down and ask ourselves, okay, well, did the cost of this inventory item go way up? Um, what is there more demand for this item? Is that why it's costing us more? Do we need to charge our customers more? Okay, these numbers, these you know, comparisons are just the starting point, the jumping off point to give us a chance to dig a little deeper and figure out what's going on within the company. Okay. Again, our sales increased by 8%, but our net income decreased by almost 22%. What the heck? Okay. There was an increase in both costs of goods sold and operating expenses, and these increased costs more than offset the increase in sales, yielding an overall decrease in net income. All right. So trend percentages state several years' financial data in the terms of a base year, which is going to be equal to 100%. Remember how I told you that we could compare multiple years using a trend analysis, okay? So our trend percentage is going to be our current year amount divided by a base year amount times 100. All right, so we're looking at the income for Berry products for the years 1 through 5, 5 years here. We will do a trend analysis on these amounts to see what we can learn about the company. Okay, so here is the raw data. All right, these are just dollar values. Okay, we're going to use year 1 as our base year. So this will be 100%. Okay, then we do our calculation accordingly. Okay. And we discovered that in year 2, we had an increase of 5%, year 3, 16%, year 4. So we're in an upward trend, okay, when it comes to sales. Our gross margin also in an upward trend, okay? The cost of goods sold is increasing faster than our sales, though. So in our current year, sales are at 145% of what they started out with, but costs of goods sold are only 150%. Maybe stammering here, maybe we need to increase our prices in order to keep pace with the cost of our inventory. Okay. Otherwise, we're going to slow our gross margin. Okay, so we can graph these trend percentages so we can see our trend over time. We've got sales, cost of goods sold, and our gross margin. Okay, so you can see that this COGS is increasing more rapidly than our sales dollars. All right. Okay, so that's the horizontal analysis. Now we're going to look at vertical analysis. Okay, this looks at the relationships between financial statement items at one point in time. So the horizontal analysis was year over year, but we're staying within the same account. The vertical analysis, we're comparing the different accounts to each other within the same year. Okay, so for this, we often use a common size financial statement. It's a vertical analysis in which the financial statement items are expressed as a percentage. Okay, so on a balance sheet, we usually use total assets as our base, and each item on the balance sheet is a percentage of total assets. Okay, when we're talking about the income statement, we usually use sales as our base, and all other items are recorded as percent of sales. Okay. So let's look at Clover Corporation again, using this vertical analysis. Okay. So sales, because that's our base, is going to be expressed as 100%. Okay. So this year's operating expenses, all right, divided by this year's sales, almost 25%. Okay, our operating expenses are almost 25% of sales. Last year, almost 26%, or they were 26% of sales. Okay. All right, so what conclusion can we draw from this? Okay, that a large portion of our profits are being taken up by these operating expenses, right? This could be an area where we could lower costs to increase our net income. Okay, remember that horizontal analysis is a side-by-side comparison of 2 or more years. The vertical analysis is comparing different accounts within the same year. Okay. So now let's look at ratios. Okay, for comparing our income statements. All right, so here we have Norton's balance sheet, got assets, liabilities, and equity, and here's our income statement. Okay, so based on these financial statements, go ahead and feel free to open your slide deck in another window and flip back and forth. We're going to be using these financial statements for a whole bunch of ratios. Okay, so the first bit we're looking at is liquidity. Okay, that measures how quickly you can or how how to put this, how quickly you can convert your assets to cash, though we use that exact verbiage later. Liquidity is how much of your resources are free to spend versus being tied up in investments in your company. Okay. And liquidity is kind of tricky, right? Because we want to have enough money to cover our debts and grow the company, but we also, do our day-to-day operations, rather, I should have said, cover our debts, do our day-to-day operations, but we also want to reinvest and grow our company, right? So we have to kind of strike a balance there with liquidity. Um, so the excess of current assets over current liabilities is known as our working capital. All right. Working capital isn't free. It must be financed with long-term debt and equity. All right. So current assets, current liabilities, this gives us our working capital, right? Then our current ratio is current assets divided by current liabilities. Okay, the current ratio measures a company's short-term debt paying ability. All right. If your current ratio is declining, it could be a sign of deteriorating financial condition. Okay. Um, it could also happen if you are getting rid of your obsolete inventory. Okay, so you may not be in trouble. This might be part of your growth as a company. All right, again, these ratios on their own just invite us to drill a little bit deeper. Okay. All right. The acid test ratios. This is quick assets over current liabilities. Your quick assets include cash, marketable securities, accounts receivable, and current notes receivable. All right, this is the company's ability to meet obligations without having to liquidate their inventory. All right. All right. So for asset management, we got a different group of ratios. Okay. Um, again, we're using Norton. Okay. We have our accounts receivable turnover. This is how many times the company converts its receivables into cash each year. Okay. That is our sales on account divided by the average accounts receivable. In the case of our friends here, they turn over their accounts receivable 26.7 times per year. Okay. Related to this is average collection period. This is calculated by taking 365 days and dividing it by the accounts receivable turnover that we calculated on the previous slide. Okay, this ratio measures on average how many days it takes to collect an account receivable. This is also used to help us determine our uncollectible accounts. Okay. How long can these go before we determine them to be uncollectible? Okay. All right. So inventory turnover is cost of goods sold divided by average inventory. Okay. This is a measure of how many times a company's inventory has been sold and replaced during the year. Okay. If a company's inventory turnover is less than the industry average, either it's buying too much inventory or it's buying the wrong types of inventory and people don't want it. Okay. Um, so again, this ratio is about how many times they sell out their inventory and replace it during the year. In our example, our company is completely selling at their inventory 12.73 times per year. This is an industry standard. So you're going to sell out your inventory very quickly if you're selling small, inexpensive items. If you're selling larger, costly items, your inventory turnover is likely to be much lower than this. Okay. I know we're going through this very quickly. Please feel free to ask questions when we're face to face. But again, I just want to introduce you to these. All of these formulas are plug and chug. You're just going to take the data off of the income or the financial statements rather, and plug them into this formula and solve. Okay. Um, all right. So next up, average sale period. This is the number of days on average that it takes to sell out the entire Inventory. The average sale period is 365 days divided by the inventory turnover, which we got on the previous slide. Okay. If you're using a just-in-time inventory system, this might tell you how often you need to order new inventory. Okay. So the operating cycle. This measures the elapsed time from when the inventory is received from your suppliers to when cash is received by your customers, right? You want to add together your average sale period and your average collection period, and that's going to give you your operating cycle, okay, in days. All right, total asset turnover. That's sales divided by the average total assets. This ratio measures how efficiently a company's assets are being used to generate sales. Okay. This is going to expand beyond current assets and also include all your non-current assets. So when you invested that money into new buildings and more sales floor space, did it actually increase your total amount of sales? Okay. Um, let's see. Debt management we're going to look at next. So we've got a variety of different ratios for debt management. We're going to be using Norton Company again, and we're going to be looking at their income statement. Okay, so we have times interest earned. That's our EBIT, earnings before interest and tax, divided by interest expense. Okay, this is a common measure of a company's ability to provide protection for its long-term creditors. All right. So when you're taking out loans or mortgages, how likely are you going to be to cover those expenses in the distant future? Okay. So this is unlike our current and acid test ratios where we're just trying to cover our short-term debts. Now we're diving into long-term debts. Okay. So if you have a ratio of anything less than 1, that means you're not covering your long-term debts, right? Okay. So debt to equity ratio, most of us are familiar with this. A lot of lenders use this for individuals as well as businesses. This is your total liabilities divided by your equity. Okay. And this indicates the relative proportions of debt to equity. Okay. Um, Stockholders like a lot of debt if the company's rate of return on its assets exceeds the rate of return paid to customers. Okay. Creditors prefer less debt and more equity because equity represents a buffer of protection for those debts. Okay. All right. So again, debt to equity ratio, total liabilities over equity. The equity multiplier. This is average total assets divided by average stockholders' equity. All right. This ratio indicates the portion of a company's assets that are funded by equity. Okay. It focuses on the average amounts maintained throughout the year rather than the amounts at one point in time. Okay. All right. Now, and again, I know this is a lot. I know these are a lot of formulas. Okay. It's really just to introduce you to this catalog of tools that you have as managers to describe, and as investors, to describe a company's health. Okay. You are not going to use all of them all of the time. Okay. As investors, you may be using one or two of these. I pointed out the ones that we use as auditors. Okay. As a manager of a company, you might use 3 or 4 to assess the health of your company internally. Okay. But you won't need all this entire catalog all the time. Okay. So don't be intimidated. All right. Now we're going to look at the big one, profitability, right? This is what everybody's interested in. Okay. Um, so we are going to use this information in the following slides. So keep a hold of this. First of all, we have our gross margin percentage. This is gross margin divided by sales. This indicates how much of each sales dollar is left after you deduct the cost of goods sold to cover your expenses. All right, and then also provide profit. Net profit margin percentage. That's net income divided by sales. Okay, so in addition to cost of goods sold, this ratio looks at how you're selling and administrative expenses and interest expense and your taxes are influencing your overall performance. Okay. Return on total assets. That's net income plus interest expense times your tax rate, okay, one minus your tax rate, over your average total assets. Okay, this is where you're adding your interest expense back to net income. Okay, so your return on assets is being compared for companies with different amounts of debt over time for a single over time for a single company that has changed its mix of debt and equity. Okay, return on equity. This is how well the company is using the owner's investments to earn income. Okay, this is important for investors also, right? This is net income divided by average stockholders' equity. Okay. You can also use the DuPont formula. Remember, we learned that in the last slide, return on equity, net profit margin times total asset turnover times the equity multiplier. Okay. Financial leverage. This is the difference between the rate of return the company earns on investments in its own assets and the rate of return that the company must pay to its creditors. Okay. So if the return on investment in assets is greater than the fixed rate of return on borrowed funds, then you have a positive financial leverage. The opposite is also true. If your return on investment in assets is less than your fixed rate of return on borrowed funds, then you have a negative financial leverage. I'm going to skip this concept check. You are welcome to work that on your own. Now let's look at market performance. Okay. Again, we have our data for the Norton Corporation. All right, earnings per share. That's our net income divided by the average number of common shares outstanding. Right. Whenever a ratio divides an income statement balance by a balance sheet balance, the average for the year is used in the denominator. Average. Earnings form the basis for dividend payments and future increases in the value of shares in stock. Okay. So as an investor, you are going to want to see a high earnings per share, right? Okay. Price to earnings ratio. Okay. This is the market price per share divided by the earnings per share. Okay. A higher price earnings ratio means that the investors are willing to pay a premium for a company's stock because of optimistic future growth prospects. Okay. I have something to add to this. It's not often that I disagree with your book, but this is one of those times. For the purposes of assignments and tests and things, please reference this. Okay. However, there are many reasons why a stock can be overvalued, not always market optimism. For example, we have some phenomenon called vanity stocks. Okay. Oftentimes people like to be a part of something that they recognize or that's particularly popular or that brings them joy. Okay, so brand names like Google or Nike or Disney, these stocks tend to be almost ridiculously overvalued because people want to own a piece of this company that they really enjoy. Okay, so I wanted to put that out there that, you know, just because a stock is overvalued doesn't necessarily mean that the experts think that it's going places. Okay. Anyway, moving on. So, next up, the dividend payout ratio. Okay. That's the dividends per share divided by earnings per share. Okay. Um, This is big for investors, okay? The ratio gauges the portion of current earnings being paid out in dividends. So investors who are seeking dividends would like this ratio to be quite large. Here's the thing, as an investor, when a company has excess money at the end of the year, they can pay it out to their stockholders, okay? Or they can keep that money in-house. They can retain those earnings to grow the company. All right. So paying out dividends gives you, as the investor, a short-term um, bonus, right? But if the company grows, the value of the stock grows. And that's another way you can make money off that stock. Okay. So just be advised there's more than one way to make money off your stocks. And a company that pays out all its money in dividends may not, I mean, depending on what your goals are, they may not always be the best bet. Okay. All right, the dividend yield ratio. This is the dividends per share divided by market price per share. Okay, this ratio identifies the return in terms of cash dividends on the current market price of the stock. Are you getting your money's worth as an investor as far as dividends are concerned? Book value per share. This is the common stockholders' equity divided by the number of common shares outstanding. Okay, this measures the amount that would be distributed to the stockholders if the company had to be liquidated tomorrow. Okay, if the company fails, it's got the assets have to be liquidated. How much are you going to get? All right. Here is a summary of different sources for continued information on financial analysis. Okay. Um, if you guys have any questions, comments, concerns, please bring those to my attention when we meet in person. Thank you, thank you, thank you for watching this video and tuning in and getting through all of this material. It is a heavy lift, and each and every one of you deserves a pat on the back, especially this chapter. It's very dense. It's very difficult to make it anything other than it is. And so I really appreciate your attentiveness for this particular lecture.